Let's now connect with Chetan Nair, Managing Director, Asia Pacific and economist with Morgan Stanley. He joins us from Hong Kong. Chetan, good morning. Thank you for joining us. Chetan, do you see India moving in the right direction? The center is making all the right noises. Reserve Bank of India now also has joined in the party. What else would you like to see coming from the government now?
Yes, very much. We think the government's measures over the last 4 months have been going in the right direction. Particularly what we have been watching is the government's effort to reduce fiscal deficit and revive private investment. And we think that a few measures, particularly increasing diesel prices, slowing down government spending, trying to get the retail investment, FDI investment in retail. So all these measures taken together we think are going in the right direction. But of course we need to continue to see a lot more to ensure that we are completely out of this current stagflation type of environment.
Right. So how soon do you expect growth to pick up for India, and do you think we can see a pickup in investment also?
I think the pickup in investment will take much longer in this cycle. In the initial phase, actually, before we see a meaningful recovery in growth, what we would be watching is the improvement in the macro stability indicators, and the market will actually feel much confident with this macro stability indicators improving. So we are watching CPI, current account deficit, and deposit growth. As long as these indicators move in the right direction, that will be more important in the first phase before we actually get a meaningful recovery in growth rate. In fact, it would not be possible to get a significant recovery in growth without getting macro stability indicators in control. So I think we need to watch this in 3 phases. The first phase is the policymakers' actions. The second phase is actually reducing the macro stability issues. And third stage is when we actually see a meaningful pickup in growth rates.
Chetan, the main event that will decide India's fate in the near term is the budget. You expect focus on fiscal consolidation, but are you convinced that the fiscal deficit would be reined in at 4.8% for FY14?
Yeah, we think that the budget will try to stay focused and ensure that the fiscal consolidation is delivered. We have no reason to doubt the commitment from the government, and as always we would like to watch the walk rather than the talk, and the walk, as you can see in the last few months, is pretty much in the right direction. So the government has essentially worked in 2 ways to try and control fiscal deficit. First is to reduce oil subsidy, and second is to cut down the government spending excluding interest and subsidy. An interesting stat to note there is that the government spending excluding interest and subsidy is down to 5% year-on-year growth in the last 3 months compared to 15% in the preceding 3 months. So if they can contain the government spending excluding interest and subsidy and try to ensure that diesel prices keep going up as they have already pre-announced, I think that should take care of the effort on fiscal consolidation. So yeah, the budget will be actually, we think, continuing to deliver on that effort on fiscal consolidation.
Right. And a 25 bps cut done, how much more do you expect in 2013?
We're expecting about 50 to 75 basis point additional rate cut in 2013, and we think that the stagflation type of environment will be reversing as the government's effort bears fruit in form of deceleration of inflation and a gradual recovery in GDP growth rate.
Chetan, could there be a possibility of inflation hardening in the second half of FY14, which is in second half of this calendar year?
Well, unlikely, as long as we think the government continues with its effort towards fiscal consolidation, and in the background, mind you, the rural wage growth is also decelerating. If we have these 2 line items supporting us in terms of improving the inflation environment, we don't think inflation will become a big issue in the second half of financial year 2014.
And do you see steps taken by the government to control current account deficits exceeding?
Yes, we do think that the current account deficit will begin to moderate going forward. The improvement will be gradual though, because mind you, the government is also trying to revive investment. So saving minus investment is equal to current account deficit. So while investment goes up, it will be hard to reduce the current account deficit significantly, but we will get some support on that to the extent to which the government cuts its deficit and augments the public savings. And what we would rather focus on is not exactly just the level of current account deficit, but also the mix or the nature of current account deficit. So if the government is able to cut its deficit, increase public saving, and if we have a simultaneous increase in investment, that would still be a better current account deficit to have than what we have today. So yes, the levels of current account deficit will moderate, but more important there to focus would be the nature of current account deficit.
Chetan, so where do you see rupee finally settling?
Ultimately, the fundamentals of the rupee will be driven by what happens to India's inflation and inflation differentials. Now, to the extent to which we expect inflation to start to moderate going forward, we do think that the fundamentals of the rupee are improving. Having said that, in the near term, since the current account deficit will still be quite high, it will be depending a lot on what happens to the capital inflows, which is not exactly in control of India, and it will be more dependent on what happens to the monetary policies of the developed world economies.
Chetan, good having you on the show and good chatting with you as always.